Why, hello there. Welcome to Credit Confidence with the fabulous Andrew Farrell. My name is Veronica Dangerfield, and I am here to welcome you back. We have had no webinars for the month of June because I was being an international bag lady, and I went to like 6 or 7 cities in Europe, and I had a great time. It was a classic eat, pray, love with the emphasis on eat. So welcome, come on in, get comfortable. We're going to have a fabulous session tonight. Patelco is here to support your life with financial education, to support your well-being and increase your financial capacity. So today is National Dimple Day. So if you know somebody with a dimple, give them $5. And it's also National Sugar Cookie Day. So those of you that are cookie monsters, you can have fun. So again, welcome everybody. Please put your questions under Q&A. Okay, but actually, thank you so much for greeting each other in the chat. We have a robust, lively chat where all of our members help each other. So please continue saying hi on the chat. And remember, a link will be sent so that you can review the contents of this webinar. So if you don't understand something or you feel like there's a lot of information here, we will be sending it to you in a link. That's all you have to do is go to your mail. Hi, Sabrina. Okay, so also I wanted to let you know about the next webinar. It is going to be pretty interesting. I have it right here. It's going to be an economic update. And join us for an insightful discussion on inflation, the current market landscape, and the outlook for the U.S. and global economies. You will learn strategies to help you navigate 2025 and beyond with confidence. That is coming up on July the 23rd, 2025 at 5:30, and we are going to have a guest speaker. Her name is Brianna Ellsworth. So if you guys have an opportunity, please come. And now it is my immense delight to introduce to you my favorite presenter. His name is Andrew Farrell. He's super intelligent. He's warm. He's receptive. Why, he's every mother's dream. But with all of that, he is a masterful teacher. Come on down, Andrew, and show him what you got, buddy. We love him so much.
Oh, thank you, Veronica. I appreciate your introduction as always. Yes, my name is Andrew. Welcome to this evening's webinar, Credit Confidence. So today we are going to dive into just the world of credit as a whole, what it means, why it's important, how your credit score is calculated, and most importantly, how you can build and maintain strong credit confidence to empower your own financial future. So today we're going to cover things like, understanding credit reports, credit scores, how like payment history and credit utilization and all of those factors play into your credit score. And we're also going to share some products and services that we have at Patelco that are designed specifically to either help you build credit, rebuild credit, save money on interest, and ultimately achieve your credit-based financial goals. So thank you all for joining. Happy to have you here. Hopefully we take away some things from today's webinar. If you have thoughts, opinions, anything like that, be free to, throw those in the chat. We do have, like Veronica mentioned, that Q&A feature. So if you have specific questions, make sure you use the Q&A option. It helps us to be able to isolate those and see them a little bit quicker and get your questions answered for you. So for those of you who are not familiar, my name is Andrew Farrell. I am a community engagement specialist and financial educator here at Patelco Credit Union. Been with Patelco for about 7 years and in this role for closing on 3 years now. I love this role. I love financial education. I love knowledge. I love connection. I love talking to people. That all falls under the umbrella of what I do and really fuels my soul. Also ties into my side hustle. For those of you who have attended some of my webinars in the past, you will know that I also host a weekly trivia night. So I'm going to plug it again. I'll plug it till I'm blue in the face. Anybody who lives in the Oakland area, if you're free on a Tuesday evening, Mad Oak Bar. It's in Oakland by Lake Merritt. Come on out every Tuesday at 7. I host a very fun free trivia night there. Oops, I went too far. I really enjoy taking a lighthearted approach to finances. I know that finances and financial conversations are things that can sometimes be stressful, but they are unfortunately just topics and conversations that we have to have. So I want to make sure that we have these conversations in as lighthearted and fun and happy of an approach as we can. So before we jump into the world of credit, one last reminder to everyone joining. I want to make sure that we all get ready, be ready, stay ready. I always like to start my webinars with this mantra here. This is the mindset that we want people to have when they think about their financial lives. So to break it down, to get ready means to gain awareness. So today it's going to be about learning the ins and outs of credit and how that may pertain to your own individual financial life. To be ready is to actively have that awareness for when life throws its curveballs at you, and it will. Again, it's not an if, it's a when, so that you know how to make the best decisions for you and your life with this knowledge that you've acquired. And then to stay ready is just to maintain your awareness, maintain your consistency. Remember, it is about consistency, not about perfection. It's about keeping these tools that you learn in your tool belt for all the years to come. So we're going to get ready today, and then we are going to continue to be ready and stay ready in the future. So with all that said, let us begin. Credit is important to have for many, many reasons. We'll just start at the fundamental. It's not just about borrowing money, right? Credit is about access. It's about having the access to things that life will present, down the road. It's hard to buy a house, finance a car, do any kind of large purchase like that without credit. As far as also rent an apartment, get car insurance rates, to be able to have this kind of access is, very, very crucial to having a solid credit score. Strong credit profile can open doors to better rates, to more financial options, can even influence things, like I said, apartment hunting, phone plan, car insurance, all that good stuff. So first and foremost, obviously with good credit, it's important because we have easier loan approval and better interest rates. The better your credit is, goes without saying, the more likely you are to get approved for things down the road, as well as the better your rate will likely be, depending on what your credit score is. Good credit also makes it easier to get approved for a lease. A lot of times when you are doing anything, we'll talk about employment, apartment shopping, all that good stuff. They will sometimes do a background check, which can include a soft pull on your credit, which gives the person who is, the leaser or the employer a little overview of your credit history. And especially in super competitive housing markets, I live in San Francisco, it doesn't get much more competitive than that. Having strong credit can make you much more of a viable candidate for renting an apartment and having higher approval odds. Utility companies, cell phone providers, things like that may ask for lower or even no security deposits if you have solid credit. Again, it goes into them doing that background check and kind of getting a cursory overview of what your credit score looks like. Some employers as well, especially those in the finance or the government fields, will check credit reports as part of the hiring process. Again, goes back into doing a background check on you. Good credit history can help you secure that job, especially again in a super competitive job market, which I know we all deal with here in the Bay Area. And in many states, credit scores can also influence how much you pay for car insurance. So better credit can mean lower premiums. Last but not least, the American dream, the ability to purchase your first home. I do not know anybody in the Bay Area or otherwise who can afford to just buy a house with cash out of pocket whenever we want to take that first step. Hopefully for me, it'll be sometime in the next 5 to 10 years, fingers crossed. It's going to be something that you will have to finance. And securing a mortgage is kind of like the final boss when it comes to credit, if you will. you start by building strong credit with credit cards, personal loans, auto loans, things like that. And once you have a very solid foundation, then you are ready to take on the American dream of buying your first home. And I myself am working towards that right now. So everybody, keep your fingers crossed for me down the line. So we talked about credit, why it's important. Credit scores are kind of the main summary or the main grade for why your credit is important and kind of the access that it will allow you. So a credit score, also known as a FICO score, is a number between 300 and 850 that is kind of like parallel or coinciding with like a letter grade you'd get on a report card. It measures your track record of borrowing money and paying it back. FICO stands for Fair Isaac Corporation. They were the company that many, many years ago created this credit scoring model, and it's been used very widely by lenders and people of the like ever since. Generally speaking, the higher the number on the credit score, the lower risk you present to lenders, which not only gives you higher approval odds, but also will result usually in lower interest rates as well. So this is kind of how the tiers of it look as far as how they measure a credit score based on if it is good, fair, so-so credit. Generally, 300, the lowest score you can get, up to the low 600s is pretty widely considered to be challenged credit. I have seen in my years working in a branch, people with credit scores in the low 600s still being able to be approved for things. But generally speaking, if you're sub 600 and the 500s or lower, it can be really difficult to approve or to secure that approval. 630, low 600s up to like the high 600s, 689, 690 normally is considered fair credit. With a credit score like this, you're more likely to be approved. Still not a shoo-in, but more likely than you would if you were in, the bad credit range. But the rates are not going to be nearly as good as they will be down the line here. 690 to 719, 720, that's usually considered pretty good credit. You're in good shape there. You're likely to be approved for things. However, the rates will not be as good as they will be when you're in that 720, 730 plus credit score range. When you're in that area, very easy to get approved for things, very easy to secure really good rates. I should mention also, just for transparency, your credit score is not the only thing that determines whether or not you're able to be approved for a loan or not. They look at a lot of other variables. One is going to be comparable credit. So I could be someone who is 20 years old. I have one credit card with a $2,000 limit. I've had it for a year. I've never missed a payment. I've kept my balance low. I may have a credit score that is in the mid to high 700s, but I'm not able to then go and get approved for like $100,000 personal loan just because I have a high credit score. They're going to want to see me go from 2,000, maybe to 5,000, maybe to 8 to 10, so on and so forth. So you work your way up to those high dollar amounts. They also look at things like your debt to income ratio, so how much you make in comparison to what your existing debts are, whether it be your rent, your existing loans that you have. So there's lots of factors that determine your approval. You can also have 800 credit score with really great long-standing credit, but if you're not able to afford the new loan you're applying for, you still may be not approved for it. Lots of criteria goes into approval, but as far as like credit worthiness, this is how that's measured. Now, credit scores are all assigned by one of three credit bureaus. These are three bureaus, three companies that each produce their own credit score. And those three are TransUnion, Equifax, and Experian. So these are three individual companies. They all calculate your score the same. They are all producing a FICO score. They just all do it a little bit differently. So each bureau will collect their data in a slightly different way. So that's why your score may vary depending on which one a lender checks. They all essentially do the same thing, but different financial institutions will employ different credit bureaus. So when you go and apply for a credit card at, financial institution A, they may pull TransUnion. You go and apply at financial institution B, they may use Experian or Equifax, and the score may be a little bit different. The reasons that they may be different is there's a couple of them. For one, not all lenders report to all three credit bureaus. Most do, but you might find a bank or a financial institution that only reports to TransUnion and Experian. So they might have a loan product that Equifax isn't showing, which is why there's a discrepancy there. They might report on different days. So a payment might post on one credit bureau before the others. There's also different versions of FICO. There's FICO 8, FICO 9, FICO Auto Score, all these, different, we're kind of getting into the weeds here, but different versions of it that they might use differently. So I like to look at it as you have three chefs. They are all making the same recipe. They are just using slightly different ingredients. So you're ultimately getting the same thing, right? You're not going to have a 780 credit score at TransUnion and a 500 credit score at Experian. They'll all be in the same ballpark because they're all collecting roughly the same data. Just what happens on the back end, how it's calculated, because they're all individual autonomous companies. They might all look a little bit different, varying from one to the other. But generally speaking, how they all calculate your credit score is going to be the same. And that is through these 5 metrics here: payment history, amounts owed, new credit, length of history, and your credit mix. So we will start with your payment history. Payment history is how often you miss payments, how recently you've missed them, and by how many days you've missed them. This is what is weighed the heaviest on your credit score. You see it's 35% of your credit score is your payment history, which is why making sure that you make your payments on time is the most crucial thing that you can do to secure solid, strong credit for yourself. In order for a payment to go to the credit bureaus as past due, it's got to be 30 days past due. So if you've ever missed a credit card payment or an auto loan payment by a day or two, no need to fret. Just make sure you go and get that paid. The financial institution might still charge a fee, but it shouldn't negatively impact your credit. But this also says that, if you miss one payment by 30 days on a credit card today and then don't miss any more payments for the next 3 years, that one missed payment will weigh less versus if you miss one 2 years from now, 3 years from now, so on and so forth. The farther away it is, the least it's weighed. And negative payments and things like this generally fall off your credit report in about 7 years. Next, we have amounts owed. This is 30% of your credit score. So this is basically saying, let's say hypothetically, you've got 3 credit cards. Each credit card has a $10,000 credit limit. You can have never missed a payment once on any of them, but if they are all maxed out, if all 3 of those credit cards are maxed out at $10,000 each, the portion of your credit that is, making payments on time, that will be in good shape. This will not be in the best shape because the amount that you owe compared to the amount available that you have is the exact same. You're at 100% usage. So a good rule of thumb here, I'm sure a lot of you guys have heard this, for credit cards, you want to aim to keep your balances at about 30% or less of your credit limits. And this is across the board. So again, back to the scenario, 3 credit cards, $10,000 each. You want to keep, you're at 30,000 then total. So you want to keep your usage at about 30% of the total amount of available credit you have. Now that 30% can all be on one credit card. If the other 2 are at $0, you're good to go. They just want it to be total, all your available credit combined, 30% usage or less will put you in good shape. 10% is like for the best scores. If you can keep your balances at 10% or less, you are chef's kiss. But 30%, you'll still be in good shape. After that, we have new credit. So this is how many loans you've recently opened or applied for. So applying for too much credit in a short period of time, this can be a red flag for a lot of lenders. And that is where this is measured here. Whenever you hear, people wanting to be hesitant about doing a lot of hard pulls or a lot of credit applications, this is where that is affected. FICO looks at all your hard inquiries, which again is when you apply for a loan or a new credit card, and how recently you've opened new accounts to factor this in. Now, a few hard credit pulls or hard loan inquiries are normal. That is why this is weighed pretty lightly, only at 10% of your score, because we have to apply for credit if we want to obtain new loans. Whenever I apply for a mortgage, I'm going to have to run my credit. If I go and apply for a new auto loan, I'm going to have to do a hard pull on your credit most of the time. But if you're doing a lot of them close together, so let's say you go to Patelco today and apply for a credit card, then B of A tomorrow, then Chase the next day, then Wells Fargo, then BMO, and you're doing hard pull after hard pull after hard pull, back to back to back to back to back, that kind of behavior sends a little bit of a signal risk to a lender. They're thinking, why do we need all this credit at once? Why are we applying for so much new credit in a short period of time? And that kind of behavior can negatively impact this little criteria for your credit score. All right, up next, we have length of credit history. So this is the average length of time that you've had established credit. This is basically saying the longer your credit accounts have been open and in good standing, the better off you'll be. FICO looks at the age of your oldest account, as well as the average age of all your accounts, how recently they've been used, and kind of measure this little bit right here. So in general, this is again a general rule. When people say it's not a great idea to close like the first credit card that you have, this is usually what they're talking about, and why a lot of the times it's a good idea to hang on to your oldest credit card, even if you don't use it that often. My first time credit card I still have open. I fill up my gas tank maybe twice a year just to keep it active, because that is my anchor. That is the oldest card that I have, and that is what is holding down my credit age the longest. Now, I said general because there could be reasons why it might not be the worst idea to close your, a credit card if you have quite a few that are old and maybe one has like $100 or $200 annual fee you don't want to pay anymore. If you close that, you'll save that money. You should be able to bounce back. It's not a one size fits all. If you have questions about whether it's a good idea to close these credit cards or not, you can always talk to us, your trusted financial institution. But as a general umbrella rule, this is how that's measured. And then last but not least, we've got credit mix. So FICO likes to see a healthy mix of credit on your profile. This means that instead of just putting everything that you borrow on credit cards, you might also have a car loan and maybe a student loan, maybe a personal loan. It shows that you can handle both revolving credit, which is like credit cards and lines of credit, things you borrow and pay back in a revolving manner, as well as fixed installment loans. Also shows that you can handle secured loans and unsecured loans. So loans that have collateral or a house or a car or something backing it versus just a, cash unsecured loan. They just want to be able to see a nice healthy mix of credit, which hopefully you will accrue as you continue on your financial lives. Now, before I move on, one thing I want to reiterate, based on how you see credit is calculated, I want to debunk the idea that having an 850 credit score is like what we should all strive to achieve. In order to get an 850, all of these need to be perfect. So you have to have not missed any payment in the last 7 years. You have to keep all your balances super, super low on all your credit cards, have no hard inquiry in the last like 2 or 3 years, have really old credit, have a mortgage, an auto loan at one point, a personal loan, a credit card. Everything really has to line up. And even then, you still may not hit 850. So I just don't want any takeaway here to be like 850 is the goal, because I will likely never have an 850 credit score, but I still have pretty good credit if we're being honest with ourselves. Like we said earlier, 720, 730 and above, you're still in great shape. So just strive to have good financial habits, make these things happen, and you guys will be in good shape. Don't worry about getting that number to the ultimate maximum. All right, one last thing as far as credit scores are pertaining that I want to share is a Vantage score. So a Vantage score is kind of a newer credit scoring model. This is sort of an alternative to FICO. So I like to look at it as like the Coke versus Pepsi of credit scores. The only difference is you don't get to choose. You get whatever the lender, uses. So if you apply for, a loan at one institution, they may use Experian, FICO, whatever. Another one may use Vantage. Patelco uses Vantage. So when you're applying for loans with us, this is what we use. But it's basically just another option of measuring your credit. So this is something that was developed by Equifax, Experian, and TransUnion. The 3 credit bureaus came together to create this additional credit scoring model. The range is the same. It's also 300 to 850. When you see the little chart here, it's all measured roughly the same as well. So nothing is super different from the other. That's why I say it's kind of like Coke and Pepsi. They're generally doing the same things, just with slight differences between the two. One thing I do want to highlight with Vantage, though, as far as how it's different than FICO, Vantage scores generate faster than FICO scores do. So when you hear your credit score, you're mostly thinking of a FICO score, and that usually takes at least 6 months to establish. Sometimes it can take even up to a year, depending on your credit activity. Vantage scores, you'll generally have one available within, 1 or 2 months. So usually people with newer credit benefit a little bit more from having the Vantage score checked. But other than that, it's roughly the same thing. It's just another credit model, not a bureau, because the three credit bureaus, Experian, TransUnion, Equifax, they all produce a FICO score. Vantage is its own thing that these three came together to produce. Again, all kind of the same stuff. At the end of the day, it's just a fourth chef in the back room at the restaurant down the street, also making the same recipe. It all is data that is being pulled from your borrowing and paying back activity. Just the way it's calculated is all slightly different depending on who's doing the calculating. So credit scores reflect information that is on your credit report. This is a sample of a credit report right here, just so we can all see what's on it. Starts at the beginning. All credit reports are going to show your personal information. So your name, your address, your previous address, your social, your employer, all that good stuff will be in the sample credit information right there. We will also show like public records. So if you have bankruptcies, that will show up on your credit report. If you have items like in collection, medical collections, things like that, that also shows up on your credit report. It will then have all the accounts that you have that are currently reporting to credit on your credit report as well. So if you have an auto loan and you pay it off today, that will still reflect on your credit report. Years and years from now, it will just be in the closed or paid off section of your credit report. In each account section, you can see right here, this bottom one, it has the account number, it has the date it was opened, it has the lender, the account holder, it has what the current balance is, what the starting balance is. If you missed a payment one time in May of 2022, that one missed payment will be on here as well. It'll say the date that you missed it, it'll say by how many days you missed it. I look at, again, the credit score as like your letter grade and the credit report as like your report card. So it's much more in depth, has every piece of information that's on it. And it's, kind of just a holistic overview of your credit history. Now you can review your own credit report and I highly recommend everyone doing so. You can do it once a week from each credit bureau at annualcreditreport.com. So back in the day, under federal law, the law is FACTA, F-A-C-T-A. It stands for Fair, Accurate Credit Transaction Act. Per that federal law, you are entitled to one free credit report per year from each bureau. This can all be done at annualcreditreport.com. That is the only source that is authorized by federal law, so make sure you go through them. During the pandemic, Equifax, Experian, TransUnion, they came together and allowed you to get free weekly online reports because people were going through some financial tough times during that time period. So all consumers could go through annualcreditreport.com and get their full credit report through their credit bureaus weekly. This was permanently extended in October of 2023, which means you can now go and monitor all three credit reports weekly at no cost through annualcreditreport.com. I recommend everyone doing it maybe once a month or so. That may seem excessive, but if you notice any disputes or if you see any inaccurate information, you want to make sure that you catch that sooner rather than later. The worst thing could be, you're shopping for a car, you go to sit down with the lender, you have the car picked out, you're ready to go, they submit the credit application and your credit is mistakenly lower than it should be. You can dispute, you can go through the whole process to get everything fixed, but that can take a couple of months and the auto lender is not going to wait that long for you to get your credit squared out. They're going to say on to the next one. So you want to make sure you stay on top of your credit, you check your reports, you make sure everything's accurate. And if anything looks inaccurate, you dispute it with the credit bureaus as soon as possible. All right. I want to talk about credit cards real quick because I personally love credit cards. I use credit cards for everything. I spend all my bills, all my shopping, put them all on credit cards. I pay them off immediately, so I never pay any interest. All I do is earn points and earn rewards, and it's a great setup for myself. I'm a big fan of credit cards if you can use them responsibly. However, credit cards are the most expensive way to borrow, which can sometimes get people in a credit card trap. So credit cards have very high interest rates. The average credit card interest rate in America is a little over 24%. And store credit cards are actually a little higher. They close in at around 33%. So when you compare that to a personal loan or any other kind of loan product, credit cards are always going to have the highest rates. Not only are the rates on credit cards super high, They also have daily interest that compound. So when you compare that to like a personal loan, for example, personal loans use what's called simple interest. So the interest on a personal loan is accrued and amortized based on the initial principal balance. It gives you one set payment for each month that's not going to change. So it's super easy to budget with, and you know when it's going to be paid off. Credit cards don't have that. So if you rack up a balance of, we'll go back to $10,000 because apparently that's my favorite number, and you don't pay that balance off in full by the due date, each day the interest will compound and your balance will grow and grow and grow, sometimes to the point where the minimum payment is actually less than the amount of interest that you're being charged. And that's another thing with credit cards. They have very low minimum payments, which may sound like a good thing, but it's actually a lot of times just a tool that credit card companies use to kind of get you stuck in that loop. Because again, if you have a credit card balance that's got $10,000 on it, and they give you a minimum payment of, I don't know, 120 bucks, but that credit card has a 30+% interest rate, and the interest that you get charged each month is over 120 or over what the minimum payment is, it's going to be very hard to climb out of that cycle of credit card debt that you are trapped in. So ultimately, credit cards may seem like a super convenient way to borrow, but it will ultimately often lead to long-term and very costly debt. So if you're in a position where you do need to borrow, whether it's an emergency that you don't have the funds for set aside, or you just need to supplement a vacation, or maybe a wedding is coming up or something where you need a little bit more extra money, surprise vet bills, whatever they may be, there are much more cost-effective alternative ways to borrow. It may seem like the easiest thing to just swipe the credit card and be done with it, but I would encourage everybody to look at some other options. So I will say, first and foremost, personal loans, secured loans, this is, by just the way it's structured, an easier way to borrow, or I should say a more cost-effective way to borrow. The rates are normally going to be a little bit lower. Again, because they're simple interest, it's easier to budget with. You have your set dollar amount. You know that if you pay this amount, you work this amount into your budget, the full amount is going to be paid off after, however many years. Also, if you have some money in a savings account that you just don't want to completely eradicate your savings, or you have some money in a CD, for example, that you don't want to break, you can borrow against that money. You can do secured accounts or secured loans that have super low interest rates. Patelco does CD secured saving or CD secured personal loans. There's lots of ways with money that you already have that you can borrow at a super low rate against collateral that you already have. And that goes into cash out refinances. This is a very creative and clever way to borrow as well. If you have a vehicle that is within the years that you can borrow against it, so let's say you have like a 2019 car that you either own free and clear, or maybe the value of the vehicle is $9,000 and you only owe $2,000 on it, that amount that you own in the vehicle, you can actually borrow against that. You can refinance the car and take the cash out for the value of the vehicle and use that to pay for, whatever needs that you have. It's also going to be a super low rate because, again, auto loans are secured loans. They have collateral backing them. That means that the rates are going to be lower. And it's just I would rather have $5,000 in debt at a 5%, 6% interest rate versus like a 30% interest rate. And last but not least, home equity loans, home equity lines of credit. This also goes back to secured loans and kind of the cash out refinance on the cards, taking the equity that you have in your home and getting either a loan or a line of credit that you can just have there as a safety net in case of emergencies. Anybody who is a homeowner, something that I would definitely recommend looking into. As soon as I get a home, once I have enough lendable equity in my house, I plan on doing this. You don't have to borrow from it. You can have the home equity line of credit right there and never touch it. But again, in case of emergency, it's nice to have that little safety net there that you can pull from because the rate will be much, much lower than it would be on a credit card. And one last thing I will say here, if you do have credit cards that have high interest rates, you can look into things like debt consolidation or credit card balance transfers. I will talk about a very cool Patelco credit card later on that has an awesome balance transfer feature. But if you've got credit cards elsewhere, maybe you have a couple $1,000s in debt for credit cards that are at 30+% interest rate, stop on by Patelco. We can see what we can do as far as getting you into a personal loan to pay off that debt, or transferring the balance over to a lower interest rate credit card. There are always options available for you. We just don't want to default to putting all of our purchases on credit cards because that is not only not helping our credit, it is also not helping our wallet. All right. So we talked about credit scores, credit reports, how to check that kind of stuff. You can, like I said, check your credit report at least once a week. If not, I'm sorry, once a week. I would recommend once a month or so at annualcreditreport.com. But you can actually check your credit score pretty frequently. When you are checking your credit score, that's going to be a soft pull on your credit versus a hard pull, and I'll explain what that means right here. Hard pulls on credit generally occur when you are sitting down with someone and actually applying for a loan or applying for a loan online. When you request a loan application, that is a hard pull on your credit. That is what will reflect on your credit report and does impact your credit score. So we talked about earlier kind of how that red flag behavior of applying for a lot of loans in a short period of time can have a negative impact on your credit score. That's what this is. This is actually sitting down and applying for a loan and opening or applying for new credit. The flip side of that is going to be a soft pull. So this a lot of times occurs when you are doing a background check, a rental application, applying for a job. This does not reflect on your credit report. This has no impact on your credit score. The person who's doing the soft pull is just doing it because they need to verify your eligibility for whatever it is you're looking to do. Generally, it gives them a much more cursory overview of the items that are on your credit report as well as the credit score. So it doesn't go as in depth, and it also has no bearing on your credit score. You can do as many soft pulls as you want. So if you're ever applying for a new job and they say, hey, we're going to do a background check, it might come with a soft pull on your credit. Fear not, that is not going to negatively impact your credit score. If you stop by a financial institution and say, hey, I want to apply today for an auto loan, and they say, okay, we're going to pull your credit for that, that will have an impact on your credit score. And we talked about checking your credit score, so you can check it without pulling the full report. That is also free and can be done as often as you'd like. The credit scores can be checked through any of the 3 credit bureau apps. So you can download the TransUnion, Experian, Equifax app, or just go on their website and create like a profile for yourself. And you can check your score through any of those credit bureaus whenever you'd like, as well as a lot of online banking services and online banking platforms. Credit Karma is one that uses TransUnion and Equifax. I use Credit Karma a lot. It also gives you kind of a little summary of some of the items that will be on your credit report. So it's a little bit more comprehensive, and it shows you both credit scores. NerdWallet is another online app that you can use. It's got a lot of cool financial articles and educational stuff on there. You can also create a NerdWallet account and keep tabs on your credit score there as well. And a lot of financial institutions will have it built into their app where you can check your credit score. So with Patelco, if you ever go on your mobile banking app or go on patelco.org and check your online banking, there's a tool there where you can check your credit score. It's your FICO score that's powered through Experian. So you can find different avenues to check all of them. Me personally, Credit Karma covers Equifax and TransUnion. Patelco covers Experian. So those are the 2 that I use the most, just to kind of keep constant tabs on my credit score. And if I ever see it go crazy fluctuation in one direction or the other, more so than I think it should, that is when I know it's time for me to do a little bit more digging and see what's going on. All right. One last topic I want to go over before I start talking about some of Patelco's credit-based products and services are predatory lenders and predatory loans. So predatory lending refers to a practice where a lender takes unfair advantage of a borrower, usually by imposing unreasonable or impossible loan terms. These practices by predatory lenders a lot of times involve deception, coercion. They'll involve exploitation of people who are in financial tough times, which leads to borrowers taking out loans that a lot of times they can't afford. If you're in a position where you cannot afford $5,000 today and you go to a predatory lender and get a loan for a crazy high skyrocketed interest rate, odds are you're not going to be able to afford to pay that back a month from now plus. Predatory lenders, like I said, target people who are in a tough spot. A lot of times they promise fast cash, no credit check, guaranteed approval. They make it sound all easy and great and like a guiding light at the end of this dark tunnel that you're in. But the reality is those loans often trap people in long-term cycles of debt, with super sky high interest rates, high fees, confusing terms, and it can be a very, very hard situation to get yourself out of. So it's important to recognize some of the red flags with predatory lenders. First and foremost, the pressure to act immediately. If anybody tuned into my Psychology of Spending webinar, you'll know that this is a tactic people use to try to get you to not do your research and not slow down. They want you to act right now because they know that if you take a second to really think about signing your name on the dotted line for a 100% loan, you might not do it. So they'll pressure you to act immediately. The terms will be vague or confusing. They intentionally want you to not know what you're signing so that it's easier for them to take advantage of you down the road. If there's ever any fees up front, if they're charging you a fee to just apply for a loan, that should be a huge red flag as well. You can also do some research if they have no online presence or maybe just one janky website, that looks like it hasn't been designed since the 90s. That could potentially be another red flag that it's not the most reputable of institutions. And then, of course, if the loan sounds too good to be true. So we all know our own credit situations, right? If we are someone who doesn't have the best credit, we are aware of what the situation is. If we go to a place that is saying, we can give you all the money you need right now, no questions asked, when you know that your credit score and credit profile ordinarily would not support that kind of lending behavior, that should be kind of, raising an alarm in your head that this might not be the best thing that you're getting yourself into. And we'll say at Patelco, we are a credit union, we're not for profit, so we offer very honest lending options, clear rates, no hidden fees. And like I mentioned earlier, we are always here to talk through your situation first. All credit unions are going to be like this. So if something feels off, just make sure that you trust your gut, you ask questions, you do some Googling, you can read other people's reviews and experiences of these lenders that you may be looking at. Predatory lenders, again, are counting on people to act now, not take their time. So take your time, do your research, and make sure your lending decisions are well thought out and they are decisions that you are making with credit confidence. This is just a visual of what repaying a predatory loan might look like. Something very surprising, at least to me. In the US, there is no federal law that limits how high a lender can set an interest rate on a loan, right? We have no nationwide federal regulation on that, which means that payday lenders or online installment lenders can legally charge 50%, 100%. I saw a loan one time when I was in my branch days that was 400% interest. And yes, this is something that actually does happen. It's not as uncommon as some people might think. Now, I will say many states do have laws that are intended to prevent this kind of like excessive interest rate, but there's often lots of ways that lenders can get around these. These are called usury laws. Usury laws are these state-based laws that are intended to set interest rate caps. But the problem is it's state by state. Some states have laws that are much more favorable to lenders. Some states don't have any usury laws at all. So some lenders will choose to operate in those states that either have usury laws that are favorable to lenders or that have none at all. And if they are nationwide financial institution, they can just export those to their customers anywhere in the United States. There's also things where a payday lender or a predatory lender can partner with a bank that is in a state that has no usury laws, and then they can take on those as well. So there's many, many, many loopholes to where people can get around these interest rate caps. Generally speaking, there is no cap. I've seen people in California, which does have usury laws, again, have 400% interest rate. So there's always going to be a way for the lender to get around that if they want to. As you can see in this chart right here, these are all $10,000 loans, because again, that's my favorite number, that were, given to a 5-year period. So if we look at the first one, a 5% loan for $10,000 over 5 years, 5% is what you can expect. Right now, that's an actually very good auto loan rate. And if you look at it, you pay $11,300-ish over the life of the loan. That's an extra $1,300 in interest over 5 years. That's not too bad. We go to 10, 15%. We're starting to get maybe into like low rates for personal loan territory. The high end of that, about $4,000 extra in interest over the life of the loan. Again, it's not great. Like if I could not pay $4,000 in 5 years, I certainly wouldn't. But if you're ever in a position where you do need to get cash out, it's not going to you know, kill me to pay that extra amount over a 5 year period. Once we start going down the line, 30%, we're now getting into about $20,000 total. That can be like a high interest credit card. You're now paying double for what you initially borrowed. And again, if you're not paying that off immediately, you're only paying the minimum, that amount's just going to keep going up and up and up and up. And when we go to this last one here, a 5 year, $10,000 loan, if you just make the minimum monthly payment on time, if it's at 100%, you're going to end up paying over 50 grand for the loan that you initially took out. We talk about that person who had a 400% interest loan, take this and quadruple it. And that goes back to my point that I made earlier. If you do not have those funds at the time of taking out the loan, odds are you're not going to have them when it's time to pay them back. And it has gone up, 5-10 times what you initially got. So this, again, is how people fall into these debt traps. The interest grows faster than they can repay it, and it becomes impossible to repay these loans. And again, that's why it's so important to do your research, only take out loans when necessary, and be sure you are using credit with credit confidence. So in conclusion, just a couple steps here, some tips for building and maintaining good credit before I talk about some of the Patelco stuff that we can offer. First and foremost, just make sure you make your monthly payments on time. That's the easiest one. If you don't miss payments, if you make your payment in full by the due date, a good chunk of your credit score is going to be in very good shape. You stay below 30% of your credit limit on all cards. On top of that, you're going to be in even better shape. There's 2 practices you can really take with you right now to ensure that you are building credit, or 2 practices you can teach your kids to make sure they, start building credit strong when they're young, make their payments on time, and keep their credit utilization low. Again, 30% is great, 10% is excellent. Be cautious of excessive credit card usage. We do not need to just put everything on credit cards. If you're ever in a position where you need to borrow some money and all you have available right now is some available credit on your credit card, stop by and see us at Patelco. We will work with you to make sure that we can find a more creative and cost-effective way to do that borrowing that's not going to kill your credit and that is going to be a lot easier on your wallet. And of course, beware of predatory lenders. Make sure you do your research and you're not just signing on the first dotted line. Look around, compare interest rates, compare options, and make sure that when you're taking out loans, it is a decision that you are thinking about, that you're being thoughtful, that you're being mindful of, and you're not just taking them out left and right. So that is how you can build and maintain good credit confidence. I will now tell you some of the things that Patelco can offer you that can help get you on that good path of credit confidence and financial success. So we have a couple different credit card options I want to run by everybody. First and foremost is our Pure MasterCard. This is kind of like our standard no frills credit card. The rate is going to be the lowest that we offer on this Pure MasterCard. The cool thing with this Pure card, I talked about the balance transfer earlier. If you have a credit card with we'll say Wells Fargo, and the interest rate is 20, 30+%, maybe you've got a $5,000 balance on it, and that interest rate is just like, oh, it's hurting you so much. You can come to Patelco. You can apply for a Pure MasterCard. If you're approved, you can then do a free balance transfer. So what we'll do is we will cut a check against your Pure MasterCard to go pay off the Wells Fargo balance in full. So now that balance that you had at Wells Fargo that was at 30% or whatever we said, that's no longer at Wells Fargo. That is now safe and sound with us here at Patelco Credit Union. The first 6 months after you do the balance transfer, your interest rate is going to be at 0%. So you can really chip away at it, try to get that debt lowered. After that 6-month introductory period, the rate just goes to whatever the rate would normally be on that Pure credit card, which again, is going to be a lot lower than it would be at a lot of these big financial institutions. So that's one way to kind of consolidate your debt and save on some interest, is by doing balance transfers to our Patelco Pure MasterCard. If you're looking for a credit card that has a little bit something extra to it, our Points Rewards MasterCard is a great option. None of our cards, as you see here, have any annual fee. The Points Rewards card, the bread and butter for this one is kind of the points that you earn. So again, it's a free card to have, also has a very low interest rate. For this, you earn 2 points back in every dollar spent in gas and groceries, and you earn 1 point back in every dollar spent anywhere else. Those points can be redeemed for cash back, statement credit, prizes, gift cards, all kinds of stuff you can get on our website that you just earn by earning points from using your credit card. And then we also have our Pure Secured MasterCard. So if you're looking to rebuild credit, this is a great one for you. The amount can be anywhere from $300 to $10,000, depending on what you're able to put down. You still go through a credit application process, but if you are approved, meaning that your debt to income ratio supports this additional credit card, we can approve it for whatever amount you're looking to secure for yourself. So if you can spare $500, not $500,000, $500 or $1,000 to put in a secured savings account, we can use that money as the collateral for your credit card, which means that approval odds are much, much easier. And then once you get that card approved, if you make your monthly payments on time and keep the usage at 30% or less, it will start helping boost your credit so that down the road you can then apply for open unsecured credit cards. So these are some of our great credit card options that we have. As you can see, we have them for people who need to rebuild, people who are looking to save on interest, or people who are just looking to establish a good credit card with some perks. We got you covered no matter what your financial need is. We also have a couple other things that we like to offer our members who have loans with us. The first is Level Up. So this is an automatic rate reduction that we have. If you have a consumer loan with us, so a product like not a credit card, but a personal loan, an auto loan, some kind of consumer loan like that, and you make your payment on time every month for 12 months, we will drop your interest rate up to 0.5% every 12-month period, or up to 1.5% over the life of the loan. The only stipulation with this is if you're already at the lowest rate or the floor rate upon you getting approved for the loan, it's not going to go lower than that. But if your rate is a little bit higher than the floor rate, we can drop it either up to 1.5% over 3 years, 0.5% each year. All you got to do is make your monthly payment on time. You don't have to opt into anything. You don't have to call anybody or sign any paperwork for it. It's something that just happens automatically for all of our members as a reward for making their payments on time. If you are, say, making your payments on time for 8 months and on the 9th month, you miss a payment for whatever reason, you make your payment on time the 10th month, and that 12-month calendar resets again. So it's very automatic. You don't have to do anything, just make your payments on time, and we will drop your rate. This next product I want to talk about is our Score Up Credit Builder Loan. This is my favorite product that we have. So this is basically a personal loan that works in reverse. So generally speaking, personal loans, you apply for a dollar amount, say $10,000. We're not going to say that because this Score Up loan doesn't go that high. But let's say you apply for a $5,000 personal loan. You get that money right away, and then you start paying the loan off. With the Score Up loan, you apply for $5,000. We give it to you, but it's in a secured account. So you're not actually getting access to the money until the loan is paid off, but you still start paying it right away. So instead of it getting money, paying the loan off, it's paying the loan off and then getting the money. We do it that way because, there's no recourse on our end. We can approve pretty much anybody for it as long as your debt to income ratio supports it. Even if you have a bankruptcy, you can still get approved for the Score Up loan. It's a great product. All the while that you're making those payments on the Score Up loan, it's reporting to the credit bureaus as you making positive payments on an unsecured personal loan, which would be very, very hard to secure if your credit is not in the best shape. And then at the end of that time period, whatever dollar amount you applied for, it can be anywhere from $500 to $5,000. You then have that money available either as a little savings nest egg for yourself, or you can use it to pay off debt. I will share a quick story about when I worked in a branch. I had a young gentleman come in. He was 20 years old. The only credit that he had on his credit profile was a credit card that he got from a bank at one of those like student resource fairs days. He didn't know what he was doing with it. They gave him a $3,000 credit limit credit card. He maxed it out, couldn't pay it back off because he was a student, he wasn't working, and then they charged off the credit card. So his credit score was like in the 500s because all he had on his credit profile was one $3,000 charged off credit card. Well, he came in, we got him in this Score Up Credit Builder loan. We gave him a $3,000 loan at, I believe, 18 months because that came to about $200 a month, which he could afford at that time. At the end of the 18 months, he took that $3,000 that he had amassed from this loan and paid off the charged off credit card. So his credit profile went from having one negative charged off credit card to a paid in full closed credit card and a year and a half positive payment activity on a personal loan. His score, I believe, raised about 200 points in the span of 18 months, which is wild. So there's lots of ways that you can use this to help boost your credit, even if you don't need to rebuild credit and just want to have an extra credit profile on here to help get yourself back, stronger credit. This is a great option for that. If it's something you're interested in, definitely stop by a branch, visit a virtual branch. We can tell you more about it. It is my favorite product that we have. I think the world of this thing. I also want to introduce our switch to save calculator. So if you have an auto loan that maybe has a super high interest rate and you're looking about potentially consolidating that, we have a free feature on our website. This QR code will take you right there, where you just enter in the current rate, the current monthly payment that you're paying, enter in your current loan balance, and then some information about, the loan amount you're requesting, what your credit score roughly is. And it will do an automatic savings calculator for you. So it'll calculate how much money you could save in interest. It will tell you how much money you could save over the life of the loan, what your monthly payment could be lowered to. It's also super honest. So if you have a interest rate that is lower than what we can offer you, it will tell you that too. It's not going to put you in a product or recommend a product that is actually not financially viable for you. It will just give you an honest comparison of what Patelco should be able to provide you based on the information you input in comparison to what you actually have. So this is a great tool just for comparing existing products that you have to Patelco, especially if you have an auto loan that you think you might be able to save a little bit more interest on. And then last but not least, I want to tell you guys about all of our fun stuff. You guys are joining this webinar here today. I hope that you learned a lot. If you are curious about any of our previous webinars, this QR code right here will take you to our YouTube channel. We have all of our previous webinars stored there. So if anything I talked about today, rung up any alarms and you want to learn a little bit more, all these webinars are uploaded to our YouTube channel. Definitely go and check those out there as well. We have short little bite-sized 15-20-minute podcasts on our podcast called Small Talks for Big Change. It is available wherever you get your podcasts, so Spotify or Apple Podcasts. Go and check that out as well. Again, little short episodes covering a variety of financial topics. I'm a frequent guest on there as well, so go and listen to me talk to you some more if you'd like on your drive to and from work. And then last, make sure you follow us on socials. Put this out to your kids also who may be on social media. We are at Patelco CU on TikTok and Instagram. You can go check out all of our fun little updates on social media channels as well. We would love for you to hit the follow button and stay up to date on all of our happenings. If you have any questions, ideas for future podcast episodes, if you need additional help, if you have feedback, anything you want to tell us at all, please shoot us a line at webinars@patelco.org. We would love to hear your thoughts. We would love to hear your feedback. If there's something that you're just saying, I would love Andrew or Veronica to talk to me about for an hour, send us that. We can take it into consideration, and maybe, who knows, your idea will pop up on a webinar or a podcast episode in the future. Even if you just want to tell us what you had for lunch today, shoot us a line. We like to be able to stay in contact with our members, and we would love to hear from you.
Andrew, what a wonderful job you did.
Thank you so much. Thank you. This is also our new member promotion. One last thing before I send everyone off. Anybody who is not an existing member, or if you have a relative who you would like to refer over to Patelco because you're just so happy with our products and our services and who we are, anybody who opens up a free checking account with us with a $100 opening deposit, as well as adds one of our money market savings accounts using this code right here, we can give them a $100 bonus as well. Take a screenshot of this, take a picture of the code, stop by your branch, stop by the virtual branch, and they can explain more about our new member offer as well.
Just one question, Andrew.
Yes.
Norma says she's noticed that more people are using P2P apps like Zelle, Venmo, Cash App, Google Pay, Apple Pay, PayPal, instead of credit cards.
Those are like different kinds of products, right? So like the pay-to-pay apps, the Zelle, the Venmos, Cash Apps, is more so for paying your friends back. You know, you can like create balances on those that you can use to pay friends, but that's more of a way that makes it easier for you to, you know, split the cost of dinner with a friend, or, you know, pay for, you know, something that a friend bought for you. Whereas credit cards are like the bank actually lending you funds. So I think that more people are using those pay to pay apps because they are a very convenient way to like transfer money to and from your friends and family or whatever. But they're not really offering the same product that a credit card would offer.
You did an absolutely thorough job.
Oh, thank you.
I even learned something new. I love the way you speak. So I want to say thank you so much, Andrew, for bringing your talents to Patelco and our members tonight.
Thank you.
And I heard you're going to see Beyonce.
I am leaving on a flight 24 hours from now, heading to Atlanta, going to night 3 on Sunday of the Cowboy Carter Tour in Atlanta. Very, very excited. You will not see me until next week.
Well, have a great trip. And I wanted to thank everybody for coming. We'll see you in 2 weeks for the economic update. And thank you so much for taking care of your financial health here with us at Patelco. Have a fantastic evening, and thanks for coming.
Bye.
Bye. Hey, thanks for watching. Want more financial advice? Make sure you watch the next video here. And you want to hit that subscribe button here.